Well, hi, good afternoon. It's Boyd and Greg here from Archetype Financial, two guys talking about money. Isn't that what we're calling us?
Yeah, that's us.
The inaugural sort of podcast edition. And what we've done is we've polled our clients for a number of questions that they typically would like to ask. Greg, you've done a pretty good job of assembling some of these here. Maybe we could just go through a couple of these and
Okay.
help to
Sounds fine.
dispel some rumors and some myths that are prevalent among the financial advisors that we know.
Okay. The first question I've got is a theoretical question. I'm 54 years old. That's not me, by the way.
Nor me.
I'm 54 years old and I haven't started saving for retirement yet. What should I do? I think this is a fairly typical question.
Okay.
There's a lot of people in that age bracket who are not that far away from retirement and need to start doing something because so far they haven't.
So what should they do? What's a good way to get started?
My first recommendation would be to start something now, even if it's only $50 or $100 a month. That would get you going, and it would get you used to having a small savings budget, which would begin to achieve what your needs are. It's not enough, but it's better to get started small and then build.
So kind of like the old adage of when's the best time to plant a tree, right?
Yeah.
The best time is 20 years ago. The second best time is today.
Right.
So get started now.
Yeah. How is another question. How do you get started? I'd recommend, again, a not too aggressive tax-free savings account. And there's a reason for that. You set up a goal for how much you want in the TFSA as your emergency reserve. And when you get over that amount, whatever your emergency reserve is,
It's different for everybody, I guess.
because you may already have some or none at all. Other people may have quite a bit or plenty. But when you get over the amount that you want for your emergency reserve, most of the excess in your TFSA can now be moved over annually to your RSP account for a tax deduction.
I see. So you're topping up one vessel or one bucket to a point where you're comfortable, and then you take the excess and you put it into another bucket, the RRSP or the Registered Retirement Savings Plan.
And the other advantage of doing it that way is the TFSA builds gains while it's in the TFSA, and you get to take the TFSA money plus all the TFSA gains and move the whole works tax-free into an RSP. So you get more than you initially put in, theoretically, and the tax-free situation helps out.
And then the contributions to your RSP
Are tax deductible.
Declared against your income tax. Declared against your income in that tax year.
That's right. So you get the benefit of tax-free from the TFSA,
Right.
and the tax deduction from the RSP.
That's excellent.
Yeah.
That's excellent. I suppose the only thing that has to be concerned about if there's any threshold limitations as far as maximums or anything like that.
Yeah, maximums are fairly understandable. If you're worried about that, you can just sit down and work with us as your advisor or your own advisor, whatever you want. But if you sit down with us, we can plan the whole thing out so that we avoid going over limits, because there's penalties on both the TFSA and the RSP, unpleasant penalties.
Especially if they're unexpected.
if you're over limit. So you want to avoid that, and we can help you do that. That's part of our job.
You actually segue nicely into a different question that I'm thinking about, and I don't think it's on the next page or anything, but it's why, you mentioned working with us as advisors or whoever you're working with. Why, as a new investor, couldn't somebody just go down to the bank and set this up?
Theoretically, they could, but will you get the amount of service you need? That's a whole nother question.
Okay.
And
So I can answer this question, but
Right.
I'd like to hear your answer. What's the advantage of working with an independent advisor?
just a minute. We'll get to that page. Yeah. I don't want to slag banks here, but I'm going to slag banks.
Well, do it gently, because
yeah.
you never know who our audience is going to
That's
be.
right. Banks are often more collectors of investment assets than they are managers of those assets. They'll put you into an investment, but will they manage the investment? Will they research better investments as they evolve while you're invested? Will they get you out of an investment that's starting to underperform? When the markets change, will a bank change their investment to suit general market shifts? A lot of that won't happen to the extent that you need it to happen with a professional advisor. The banks have a tendency to put your money into term deposits as well. Term deposits at low interest rates,
Okay.
which means low rates of return. And
lack of liquidity, I would wager,
well,
too.
yeah, it's even worse than that because low interest rates are bad enough. They're often a little bit lower than the inflation rate. And the problem with that is if your inflation is, say, 2.5%, and your interest rate is 2%. You need 2.5% just to break even so that you've got the same amount of spendable money as inflation shrinks that money.
Okay, so it's not eroding your investment, in other words.
Right.
Okay.
So you need to make what's called a real return, which
Right.
is a return over and above the inflation level so that every year you get enough to spend to buy enough groceries or the same amount of groceries next year as you bought this year.
And so if a bank is handling your investments and they work with a term deposit or a GIC, there's a risk that you're not going to be able to achieve that real rate of return to
Yeah.
stay ahead of inflation.
And then there's another concern. Low interest rates are bad enough, but when an interest opportunity comes your way, whether in interest rates or stock investments, you're locked in with your bank deposit type investments.
Hence, term deposit.
Term deposit. So if you go in for, say, a 3-year deposit to get the higher 3-year interest rate, fair enough. But if at 2.5 years there's a significant opportunity for you, or if there's an emergency and you need your money, one way or the other, it's 2.5 years into the 3-year term. If you need to pull that money out to move it elsewhere or to have it available to spend, you can usually, not always, but usually get it out. But you have to sacrifice all the interest that you earned up to that point. So you had it in for 2.5 years. You gave it to the bank for 2.5 years to use as they see fit and make money with it. And after 2.5 years of the 3-year term, the bank says, well, okay, here's your money, but we're not paying you any interest.
So that's the penalty for
That's the
taking your
penalty.
money
We're
out
not
early.
paying you any interest because you broke the agreement.
Okay.
So not good.
You know, my experience working with a bank, because I was a client before joining Archetype, I was a client at a bank. And they're, although they never worked with me to put my investment monies into a term deposit or a GIC, what they did do was they put them into proprietary mutual funds that only that bank sold. And so, as I've come to understand, what that often can mean is that it's beneficial more towards the advisor and the bank versus the client.
Yeah.
And you know, I'm not going to call anybody out here, but my investments did make money, but I fear that if I was to go back and do it again and work with yourself as an independent advisor, I probably could have gotten a fair bit more of a shake out of it.
You probably could. I know with Archetype Financial, one thing we do is we've expanded our investment network. So we have a main fund supplier, but we've added 2 others more recently. So now you have the base one, you have a slightly more aggressive one, and you have an ethical, environmental oriented fund as well. So you've got a number of options, and we can move you back and forth from one to the other, depending on what you want, what you like, what your comfort level is, and what your need for returns is. So we're not going to be wedded to any source of funds. We're going to do what you need us to do to create what you need us to create, and do it safely.
We're independent advisors.
Yeah.
Right? And that's actually what you make is a really great point, because there are some investors that come to us and have concerns about where their money is going to be invested. They have limitations. They, for instance, don't want it to be invested in, say, military stocks, or and they have ideally what they want to see is their investment monies go towards a company that has a very large environmental tendency. They're concerned about the environment, and their business practices either are purporting environmental issues, or I'm phrasing it wrong, but you know what I'm talking about.
Yeah.
So, there are fund companies that we have access to in our purview that, fit those needs very, very nicely.
Yeah.
So
that's it for the moment. Stay tuned for the next one.
Yeah, thank you. This is Boyd and Greg again from Archetype Financial. You can reach us through email or through the link below. Thanks.
Thank you.